Hello viewers. Welcome to our YouTube channel. Today, our topic is how to do crypto trading technical analysis through TradingView. What is technical analysis? Technical refers to analyzing the past trading activity and price variations of an asset, which according to technical analysts, might be useful predictors of future price movements of an asset. It can be used for any asset with historical trading data, which means stocks, futures, commodities, currencies, and cryptocurrencies. Why should beginners begin with Bitcoin? If you are new to the world of blockchain and cryptocurrency, it can get overwhelming to filter out reliable cryptocurrencies from unreliable ones. Several cryptocurrencies, popularly dubbed meme coins, like Dogecoin, Shiba Inu and Bitcoin, have popped up in recent times and have cost rookie investors a large chunk of their investments. On the other hand, Bitcoin is a much safer, if not the safest, cryptocurrency to invest in. It is the first deflationary crypto token to come into existence and has recently reached an all-time high ATH of over $65. What is the best time frame for crypto trading and what is multi-time frame analysis? Multi-time frame analysis is the process of viewing the same asset under different time frames. For example, a swing trader might use a daily chart to see the long-term trend and then a 4-hour chart to find specific entry and exit points. The optimal time frames for identifying trends and entry points depend on the type of trade and holding period. As a general rule, traders should use a ratio of 1:4 or 1:6. Such as a 1-hour chart for entries and a 4-hour chart for spotting the trend. While it's possible to use more than 2 time frames, the added complexity creates diminishing returns when it comes to realizing tangible benefits. But how should traders determine the best hours to trade Bitcoin? Most traders should stick to 2 time frames when starting out and perhaps expand to a maximum of 3 if they need it. Here are some more reasons to trust Bitcoin. 1. Most decentralized cryptocurrency. 2. Deflationary token. 3. Publicly available white paper for proof of work (POW) mechanism. 5. Crystal clear tokenomics. Support and resistance are key concepts used in technical analysis of assets, including crypto assets. Support is a price level where a downtrend can be expected to pause due to a concentration of demand or buying interest. As the price of an crypto asset drops, demand for the asset increases, thus forming the support zone. And vice versa. Resistance zones arise due to selling interest when prices have increased, how the price had been rising, a level at which the advance was met with selling resistance. It is the level at which sellers are as powerful and aggressive as the buyers and stop the advance. When the sellers become more powerful than the buyers, the price declines from the peak. Support and resistance are key concepts used in technical analysis of assets, including crypto assets. Support is a price level where a downtrend can be expected to pause due to a concentration of demand or buying interest. As the price of an crypto asset drops, demand for the asset increases, thus forming the support zone. And vice versa. Resistance zones arise due to selling interest when prices have increased, how the price had been rising, a level at which the advance was met with selling resistance. It is the level at which sellers are as powerful and aggressive as the buyers and stop the advance. When the sellers become more powerful than the buyers, the price declines from the peak. Why do support and resistance occur? Have you ever bought a coin, watched it decline in price, and hoped to sell out for what you paid for it? Have you ever sold a coin, watched it go up after you sold it, and wished you had the opportunity to buy it again? Well, you are not alone. There are common human reactions. And they show up on the price charts by creating support and resistance. How to find support and resistance? Finding these key level can be tricky. Generally, support area forms around the previous price lows, while resistance area forms around the previous price highs. Once an area of support or resistance has been identified, those price levels can serve as potential entry or exit points. Here's how to trade breakouts and approaches. A price break above the resistance zone implies that sellers are satiated at that level and buyers are anxious. See the upward breakout in the Bitcoin chart above. If another resistance zone exists above the one that was just broken, prices will typically trade up to that next higher zone. Thus, a resistance zone in an advancing market can become a price objective once a lower resistance zone is broken. This logic also works with support zones, in reverse. How are support and resistance zones drawn? To draw a support and resistance zone, simply draw a horizontal line through each significant trough, support, or peak, resistance. These lines can be drawn through the bar lows, support, or bar highs, resistance, or using the bar's closing price, since most investors look at closing prices. Extend these lines into the past to see if earlier price declines stopped at the same price level. The more times the price level has stopped previous advances or supported previous declines, the strong will be the resistance or support in the future. Suppose that you're a swing trader that prefers to look for entry or exit points on a 4-hour chart. Rather than using just the 4-hour chart, you might start by looking at the daily chart to get a sense of the trend. After all, the trend is your friend in trading. You see that the daily chart shows a bullish uptrend, which means that you may want to maintain a bull bias when looking for 4-hour opportunities. In other words, you might only look for long trades for the day to increase the odds of a successful trade. In addition to seeing a high-level trend, you may notice an ascending triangle chart pattern on the daily chart and use the trendline price levels as key areas of support and resistance that may not be nearly as obvious on the 4-hour chart. Crypto candlestick charts show time across the horizontal axis and private data on the vertical axis, just like line and bar graphs. The main difference is that candlesticks show whether the market's price movement was positive or negative in a given period, and to what degree. Crypto market charts can be set to different time frames, with candlesticks representing that time frame. If a crypto trading chart is set to a 4-hour time frame, for example, each candlestick will represent 4 hours of trading activity. The trading period chosen depends on a trader's style and strategy. A candlestick is essentially made up of a body and wicks. The body of each candlestick represents its opening and closing prices, while the top wick represents how high the price of a cryptocurrency got during that time frame, and the bottom wick represents how low it got. Similarly, candlesticks may have 2 different colors, green or red. Green candles show the price went up over the period under consideration, while red candles show that the price declined. The simple structure of candlesticks can offer users a lot of information. Technical analysts may use candlestick patterns to, for example, identify potential trend reversals. Cryptocurrency traders should be aware of bullish and bearish candlestick patterns. A long wick at the top of a candle's body can, for example, suggest traders are taking profits and a sell-off may be occurring soon. On the contrary, a long wick at the bottom could mean traders are buying the asset every time the price drops. Similarly, a candlestick in which the body occupies almost all of the space and has very short wicks may mean that there's strong bullish sentiment if it's green or strong bearish sentiment if it's red. On the other hand, a candlestick with almost no body and long wicks signals that neither buyers nor sellers are in control. Support and resistance levels. Reading live crypto candlestick charts is easier using support and resistance levels, which can be identified with the use of trend lines. Trend lines are lines drawn on charts by connecting a series of prices. Support levels are price points during pullbacks in which cryptocurrencies or any other asset are expected to halt due to a concentration of buying interest at that level. Resistance levels are price points in which there's concentrated selling interest. Concentrated buying and selling interests make it hard to get past these levels. Support and resistance levels can be identified through trend lines, as these make it easier to identify crypto chart patterns. An uptrend line is drawn using a cryptocurrency's lowest and second lowest lows in a given time frame. Levels touching this trend line are seen as support. A downtrend line is drawn using the crypto's highest and second highest highs, with levels touching this line being seen as resistance levels. As the name suggests, downtrend lines are used during downtrends, while uptrend lines are used. Various strategies can be used based on trend lines and support and resistance levels. For instance, some technical analysts simply buy near the support of uptrend lines and sell near the resistance of downtrend lines. Fundamental analysis versus technical analysis. Fundamental analysis is based on the idea that the price of an asset is determined by underlying factors, such as the company's performance, management, and market size. On the other hand, technical analysis does not consider any economic or fundamental factors. It is purely focused on the chart and the indicators like RSI, MACD and candlestick patterns.